All right. Well, hello, everyone, and thank you for joining us or watching this video again. You may have seen our last little video we did like this on cash flow bullets, and I've got Bob again with me today. How you doing, Bob?
Doing great, Davey. How about you?
Doing well, thank you. Bob, we're here to talk to people today about maximizing the value of their business. And, this is something that we really do on an everyday, every engagement basis with our clients, whether they realize this is what we're working on or not. Really, as a business owner or an advisor, business valuation should always be at the top of mind.
Absolutely. And it's really a long-term look for the business owner, and I'm a small business owner as well, and we tend to get caught up in the day-to-day and short-term events and shorter-term profits, but every business owner needs to be looking at where do I want this business to be in the long term? How can I maximize the value of it, not only for their self and their family, but their employees, other stakeholders? What impact can they have in the community? So it involves a lot of different factors. But yes, as you said, we work on this every day. Even some of our clients don't realize some of the things we're working on
Right.
are helping with this.
Well, before we can talk about the actual valuation, we've got to get some housekeeping and some terminology out of the way. And one of those things is EBITDA, right? So a lot of people have heard this word or phrase or whatever they think it may be, but maybe they don't know exactly what it is. They know it's something to do with profit, something to do with finance. But Bob, walk us through what EBITDA really is in layman's terms.
Sure, be glad to. And you've got a great little graphic here that I think visually explains it. EBITDA is simply an acronym for earnings before interest, taxes, depreciation, and amortization. And what that does is it takes out the financing of a business, because some businesses are highly leveraged, some aren't. So we take the interest expense out of it. We take taxes out of it because different entities, some people are LLPs, LLCs, sole proprietorships, partnerships, C Corps, S Corps. So we take the tax out of it. And then we take those non-cash GAAP requirements, depreciation and amortization. So we're left with what we think is sort of a pure earnings number. And EBITDA is also the theoretical cash flow generating ability of the business. And at the end of the day, the amount of cash flow that a business can generate really tells what the true profitability is. And that's the baseline measurement for what that company is worth.
Well, when you hear EBITDA, a lot of people think like, corporate finance, Wolf of Wall Street, Fortune 500 companies. But EBITDA is something that business owners of every level truly need to be aware of.
Absolutely. And we work with a lot of private equity companies who invest their portfolio in family owned and privately held businesses. I've never seen any of them not heavily rely on EBITDA. It's just a good, strong, common measurement of the profitability and the theoretical cash flow generating ability of that business. So everyone from an exterior standpoint, external to the business, looks at it. So if the external users feel it's important, the internal users and the owners should feel it's important as well.
Well, Bob, let's look at this actually in practice here. Okay, so we've got two bakeries. We've got Joe's Bakery and Susie's Bakery, and from all outward appearances, these are very very similar businesses. So they both did $1 million in sales and both had the same cost. But looks like Joe's business edged her out, made an extra $50,000 in profit.
Well, bottom line profit, that's absolutely correct. Joe's a little bit more profitable, but notice the depreciation, interest, and tax is $100,000 on Joe. Those are all EBITDA add backs, and on Susie, there's 150,000 add back. So when you look at those differences and compare, that's going to basically mean that their EBITDA is the same.
Well, okay, so depreciation. So Joe had $40,000. Now Susie didn't have any depreciation. So give me an example of how that can be. That I mean, because they're both the same type of bakery. How can one have so much depreciation and one have none?
Well, particularly in the bakery business, and my daughter actually is in this business now. She's looking at renting a commercial kitchen. So Susie may be doing that. She may be renting her equipment rather than
Mm.
owning that equipment and then depreciating it. So Joe would have more capital investment and be depreciating it, where Susie is renting the use and access of that equipment.
Well, that makes sense. And, I guess the interest expense, boy, Susie's really paying quite a bit more than Joe when you look at that interest. It doesn't look like she did as favorable with her financing terms.
It could be the financing terms. That's certainly correct. Different credit scores may be causing her to pay a higher interest. She may have purchased a franchise, and she's borrowed a lot of money for startup capital and be paying that back. Joe may have started his out of his own pocket, or may have had less startup costs to start with. So their capital structures are different. Therefore, their financing costs are different.
Well, speaking of different capital structures, even though Susie made less money, looks like she paid more tax than Joe.
Yes, she could be in a higher state income tax state. Her entity status could be different. She could be a C corporation, be having a higher tax rate than Joe. He might be an LLC or a sole proprietorship, a pass through entity. Um, so, yes, their entity structure makes a difference on how their tax structure is as well. So those are the kind of factors we like to take out of it. Those are owner decisions about all of those issues that impact the business, but they don't have anything to do with the theoretical cash flow generating ability of the business. This is how they're spending, not necessarily how they're generating profit.
Well, let's go ahead and take those out, the depreciation, the interest, and the tax. And would you look at that, Bob? The EBITDA is the same on both businesses.
That's right. You factor those components out, and now those businesses to an outside investor or to Joe and Susie from a financial standpoint look very, very similar. So that's the reason we factor these things out, is to try to get an apples to apples rather than an apples to orange comparison when we're looking at various businesses.
Well, I can see how an outside investor at first glance, it might look like Joe was doing better than Susie, but when you look at things that may be different, if an investor comes in and were to purchase Joe's Bakery, they may change the capital structure. They may change the debt financing. They may change what's owned versus lease on the equipment. So really, those are all variables that can change with ownership, can change with location or personnel, but the EBITDA is the same.
That's right. That's right. Because any potential buyer or even a current owner should be able to look at the structure of all that and determine what's best for them. What's best for Joe may not be best for Susie, and that's okay. But those are decisions you make on the individual business basis. But from a comparison standpoint, if I'm an investor in a bakery, these two bakeries at this point are looking very similar.
Well, Bob, we're going to go ahead and take a break here, and when we come back, we're going to talk about how EBITDA is one of the variables in our business valuation equation.
Sounds good.
Okay, well, we're back continuing on our business valuation presentation here, and we finished talking in the last section about EBITDA and how that fits in to the actual business valuation formula, which is a very simple formula I'm looking at here, Bob.
It really is. Now, there are some deeper subcomponents that go into this, but it's simply your EBITDA times your multiple. That is a shortcut way of calculating business value. And many, many investors and owners look at it this way. Now, this is not a full-blown accredited or certified valuation. That's not what we're doing here. There are independent CPAs that come in and do those. There's a prescribed set of professional standards and rules that they follow and look at a lot of factors. And many people we encourage to have a business valuation formal done before they acquire a business. But this is a metric. This is a metric that's external and internal that can be used, that's pretty reliable, absent doing a formal valuation. And we use it every day.
Well, looking at this formula, I mean, it stands to reason that one of the easiest ways then to increase that business valuation would be to increase the EBITDA.
That's absolutely right. It's if you increase 10%, the multiple also is very important, and the multiple varies by business industry. So some industries are going to have higher and lower multiples. You and I were talking earlier. Right now, it looks like medical technology businesses are 20 to 24% multiple, 20 to 24x times EBITDA. Old line manufacturers, and we have a lot of clients that are in those kinds of businesses, they have a 3 to 5 multiple most of the time. We've had IT service companies that can be in a 10 to 12 to 15 multiple. So it really varies across the board. Brick and mortar retailers are sort of out of fashion right now, unless you're a Walmart. Those what we call Main Street business retailers, those are pretty low multiples right now. But if they have an online presence and they're selling on Etsy or Amazon, they have higher multiples. So it really varies by industry and marketing channel. But you're right. One way to increase your business value is to increase your EBITDA, because you get a multiplying effect whenever you increase your EBITDA.
Well, to your prior example, Bob, in these numbers we've got here, let's say we increase that EBITDA by 10%. So we're going to increase it by $100,000, and therefore we've increased the valuation of the business by $500,000.
Yes, and that's an excellent point. And a lot of business owners miss that. They believe if they've increased their earnings or their EBITDA from $1 million to $1.1 million, they've only increased the value of their business by $100,000. But they've increased it by the factor of their multiple, which in this case is 5. So that 100,000 is now 500,000 in additional value. That's the way businesses increase their value. So the higher the multiple and the higher the EBITDA increase, the higher or the multiplying factor for the entire business. So yes, we've helped many businesses make a 10% profit improvement, which made a huge impact on their business valuation.
Well, we've been alluding to it, but now let's look at that scenario. We talked about increasing the EBITDA, but now let's talk about what can happen if we increase the multiple. And this is where it can get really exciting, Bob.
Absolutely, because now we're getting a higher multiplier effect. In this case, our $1 million times 5 is 5 million. We increased it to 5.5 million when we increased the EBITDA. But now if we increase that multiple from 5 to 6, our 5 million now goes to 6 million. So now we've increased our value, not just 500,000. Now we've increased it $1 million without a single dollar of additional profit or EBITDA, just by increasing the multiple. So it has a dramatic effect very quickly. So business owners, we encourage them, increase your EBITDA, but also focus a lot of time and attention on your multiple. That's a longer range plan. It takes longer to increase that multiple, but what are the things you can do in your business to increase your multiple? You get a much bigger effect.
Well, we always say that EBITDA improves profit dollar for dollar. And, when you add that dollar for dollar increase along with increasing the multiple, so if you're working both variables, then you can really start to make some headway in increasing the value of your company.
Yes, and we've seen many companies be able to double their value with a slight adjustment in EBITDA performance and a slight adjustment in multiple, because they're getting a twin effect there. So a $5 million company can become a $10 million company in 2 or 3 years sometimes. And they think they have to double their profits, but they don't.
Well, here it is. Here's the math. $5 to $10 million. This is with the same EBITDA, Bob. All they did was increase their multiple.
Yes, and many industries. That's why it's important to know your industry and know where you're at in your industry, and what's your room, what's your ceiling. If you're running a 5 multiple now and the industry average is 10, you need to be doing those things to get up at least to the industry average, if not beyond. So you have a very tall ceiling of room to improve and increase the value of your company.
Well, let's go ahead. We've kind of set it up here. Now we know what the formula is. So let's take a break here, and when we pick back up with part 3, we're going to do a little aside, and we're going to talk for a minute about contribution margin and why that is important when we're looking at business valuation.
Sounds good.
All right, well, we are back, and we are continuing on talking about business valuation. But as I alluded to at the end of the last segment, we're going to do a little aside here. And Bob, we are going to talk about what I know is one of your favorite topics, and that is contribution margin.
Yes. I'm a firm believer in contribution margin. Most of our clients are not familiar with this concept when we first introduce it, but it makes intuitive sense to them once they understand and we're able to explain it. It's really an old formula. It goes back many, many years. Manufacturing companies were the first to really explore this, but now it's into retail, it's into technology, it's into service businesses, and it's really a way of looking at how much profit do I make on the next dollar or next unit of revenue that I can achieve. So that's a very important to know that amount, because it allows you to then make better business decisions when you know how much you're going to keep or invest from that next dollar of revenue.
Now, when I hear contribution and I hear margin, Bob, generally, we hear about the net margin, we hear about the gross margin. How does contribution margin compare with those?
Sure, contribution margin is further up. It's not directly shown on the income statement unless you have a set of internal statements that itemize that, and we often do that with clients. But it's simply the revenue minus the variable cost, and you have the major variable costs listed here: direct material, direct labor, any kind of direct outsourcing, commissions, something that people don't think about sometimes, but commissions are normally on a variable basis based on the revenue, the sales, or sometimes they're paid after the collection of that, and then any other cost that changes when revenue changes. But none of your fixed costs, not rent, not insurance, not fixed salaries, none of those costs apply at this point. We're simply looking at, I sell another unit, or I have another $1, $10, $100, $1,000 of revenue, what changes to help me generate that? And it's material, labor, outsourcing, commissions, and maybe some other smaller expenses that vary with revenue.
I see. So if I sell 100 widgets or I sell 1,000 widgets, my rent is not going to change, right? I'm paying the same rent for my warehouse, but the cost that it took me to manufacture those widgets is going to change. Is that the difference we're talking about here?
That's exactly right. And maybe you're not a manufacturer. Maybe you're a wholesaler or a distributor or a retailer. So it's what you paid for that widget or whatever that item is that you're selling. What additional labor did you have to put into it to finish it or convert it to its final use? Did you outsource any of that, or did you do it all internally? Did you have to pay a commission on it? So yes, it applies across all businesses. Even professional service companies use this. We see attorneys and accountants, engineering companies using this kind of analysis to understand their business better. But you're right. All those fixed costs stay the same. We're only interested in variable at this point.
Well, let's look at an example of contribution margin. So we got a drill here. We got a DeWalt drill, says selling price is $100. I don't see many DeWalt drills for $100 now. Seems like they start at about $200. But anyhow, that's a different conversation. But let's look at these numbers and how the contribution margin for this drill, this item that is being sold or manufactured, is being factored. So we've got some things up top here. We've got direct material, as you referenced earlier, piece rate labor. Bob, what do you mean by piece rate labor?
Well, that would be all of the labor that goes into actually manufacturing and assembling that drill. DeWalt either does it themselves or they have a subcontractor that all the components come together. They probably buy most of those components, and then they have an assembly process. And most of those people are paid to do, they're paid, their cost maybe $10 to assemble one drill. So they're able to itemize and understand what that is. They know what all the material, all the subcomponents cost. So that's your material, that's your labor. And I see you have on here freight. So that would be the freight that's necessary to transport the goods. And then almost everybody's going to pay a commission every time a drill is sold. They're either paying that to a salesperson, they're paying it to a rep group, or they may be having to pay it to a retailer for actually selling.
Multiple commissions. Yeah,
exactly. Tiered commission structure. So there's your total variable cost, $60. It doesn't include depreciation, doesn't include utilities, doesn't include insurance, administrative salaries. All those kinds of things are not critical at this point.
So the variable cost is $60. We sold it for $100. So $100, that's our sell price, that's our revenue, minus our variable cost of $60, gives us a contribution margin of $40. And, to make the math easy here, we've used $100. So that's also a 40% contribution margin.
Yes. And that would be pretty typical in this kind of industry as well. So that $40 then is used to cover overhead, to generate a profit. And it's also, if DeWalt, for example, wanted to get into a new market channel, they know they've got $40 there to play with if they needed to reduce that selling price in order to enter a new market channel. And then they could, based on their volume and their overhead, how many do we have to sell in that new marketing channel then to break even or to make the profit margin that we ultimately want. So it gives them pricing flexibility. If that number was much lower, they might want to look at, are there ways that we can raise our pricing to get a higher contribution margin? Can we reduce the material component somewhat? Can we improve our supply chain? Can we make our plant more efficient so that our employees are making more drills per hour or per shift, and our $10 labor rate goes down to $8, not because we're paying the employees less, but because we've helped the process become more efficient, and we gain that through efficiency. We might actually be able to pay the employees more because they're more efficient, and that's something that we like to look at as well, because the company wins, the consumer wins, and the employees win, and we like to go for those triple wins.
Bob, the way I always like to look at contribution margin, and we use this drill as the example, is I know that if I sell one more drill, that $40 contribution margin is going straight down to my bottom line. We talked about EBITDA earlier. This is a direct effect on your EBITDA because you're taking out those variable costs.
That's literally true. If your company is at break even, let's say DeWalt's breaking even. I think they're doing slightly better than that, but let's just say they're at break even, and they make one more drill, their EBITDA just went up by $40. So that's the power of knowing the EBITDA, because you know where that is and where your flexibility is in pricing. It points you to what you need to do from an efficiency standpoint. It helps you decide new marketing channels. But a lot of companies, a lot of businesses that we work with don't understand this. And most companies, let's face it, Davey, they're not one product companies. They have multiple products. We like to group them in product families, in business segments, so that we start understanding our business that way, and we start understanding contribution margin by those major components. Because invariably, if they're in 5 business segments or they have 5 families of products, one's going to be higher, one's going to be lower, and the other 3 are going to be in the middle. Well, how do we push another one to a high margin, and how do we bring that low margin one up at least to the average? So it helps us where we point our efforts. Where do we put our R&D? Where do we put our engineering resources? Where do we put our marketing resources? That helps tell us this contribution margin analysis is the first step in helping to make those decisions.
Well, absolutely, Bob. And on the sales side of the house, this is a conversation that we've had with a lot of clients. As you said, normally they've got multiple services, or if they're a retail or a wholesale client, they've got a whole line of SKUs, and that contribution margin can really vary across those SKUs. And if your salespeople do not understand what the contribution margin is for that item or that division, that segment, it really you can be putting your focus totally in the wrong place, because you're expending the same energy for a lesser contribution margin product.
Yes, and there's the law of unintended consequences. And that's why we say commission programs have to be set up to help motivate the sales force to sell the products and services that we want to, which tend to be the ones with either greater volume and contributing lots of margin dollars, or greater margins, so that we can push the company toward higher profitability. But we've been in businesses where the incentive was on the low margin products, and the sales force was doing a really good job, but we weren't making any money from it.
Well, that's the worst case. Worst case scenario is the incentives on the low margin products. I think what we see most often is the incentive is the same. Somebody said, hey, we're going to pay 5%, or we're going to pay 10% commission, because it seems simple and it seemed easy, but rarely do we see that as the right way forward for many companies as far as their commission and their sales structure.
Yes, it's the curse of the average. And we're all for being simplistic about things and doing things simple and non-complicated. We don't like 44-page commission agreements. It needs to be simple enough that it can be on 1 or 2 pages, but we don't want unintended consequences. And sometimes we motivate the sales force in the wrong direction, because they're going to go where they can make money. Obviously, they're incentive motivated people, and we want them to be, but we need to decide where that is. Are we trying to build margin through volume? We're trying to build margin through each individual family. And that gets into a lot of marketing questions about, what segments do we want to be in? Where's the growth? What do we want the company to be in several years? Where do we want it to be a market leader, top 1, 2, or 3 in their geography? So this really helps us with that. But it's hard to do things on a across the board average. We never say do that, because not everything's the same. So if you have different margins, you may need to have a different commission structure for different product families.
Well, I think this is all really good info, and I know it doesn't fit directly into our equation of EBITDA times the multiple equals the business valuation, but it's definitely a portion of that. So when we come back, Bob, we're going to, in the next segment, actually start talking about ways to increase our EBITDA and increase that multiple. And obviously, as you might have guessed, increasing contribution margin will be a key part of that.
Absolutely. That's correct.
Okay, Bob. Well, we are going to continue on, and now let's start getting into some of the meat of it here. So we understand what the formula is. We understand EBITDA. We understand multiple. We understand contribution margin. But how do we increase any of those? And let's start by talking about option 1, which is simply increasing EBITDA. So in this example here, we've got a valuation of $5 million. We're trying to get that valuation to $10 million. So in order to do that by increasing the EBITDA, one way we could do that is just to double the profits, to take that profit from 1 million to 2 million. And as crazy as it sounds, that's not too far fetched. We've seen multiple companies that were able to do even more than just double their profits.
Yes, sometimes it involves thinking a little bit outside your traditional scope of how you're going to go about doing things, what your targets are. But for a company that's making $1 million profit, they're probably somewhere in the $5 to $15 million revenue range now. And we've had many clients who said, yes, we think we can double our profits. It may be a 2 or 3 or even a 4-year venture to do that, some less even. But that's not an unrealistic goal for the size companies that we're talking about and that have been our clients. In this example, if we assume an overall contribution margin of 20%, it's going to take $5 million of revenue to get there. And if you're a $5 million company, that's doubling your revenue, which is sometimes harder to do than doubling your profitability. But it's an aggressive goal, but that's one component of how to get there. Maybe you don't get it all through revenue, but maybe you get a portion of it. We like to really focus on the internal efficiencies inside the 4 walls of the company. What are the things that we control? Because we don't control the market, we don't control the economy, but we do control what goes on inside our company. So we look at process improvements, efficiencies, waste reductions, all of those types of things. Manufacturing, wholesalers, personal or professional service companies, technology companies, all can benefit with process improvements. Some of that's back-end process, some of that's sales process, some of that's what we like to call the order-to-cash cycle, from the time we accept an order till we have the cash in the bank. What are all the steps that it takes to get there, and how do we use automation? How do we improve our processes? How do we combine functions? And how do we focus on the most important factors? Many companies that we see want to focus on 10 factors rather than 3 factors that they can really have an impact. So how do we rank our priorities? What are the 3 we focus on, the most impactful? And let's work on those and increase our efficiency, because whereas revenue increase may drop 20% to the bottom line, efficiency increases drop 100% to the bottom line. And that's where we gain these profit improvements very quickly. Some people get scared away by cost reductions, and we said those drop straight to the bottom line, and they do. But we're looking at how do we take the waste out of what we're doing? How do we not take so many steps to accomplish our goal? How do we make it goes right along with efficiencies? But what are the things that are wasteful in our operation that we can reduce or eliminate? And those drop right through to the bottom line as well. So it's a combination of all of these 3 major areas.
Absolutely. And so many of our clients, especially when we sit down for an initial engagement, the only way that they're thinking about it is that increase in revenue.
Right.
Because, that's generally the most obvious. But, I'd say that we spend the majority of our time, as you said, looking at those internal efficiencies increases, looking at process improvement opportunities, and those type of things. We come in and we help them get that on track, but it's not a one and done exercise. When you talk about efficiency and process improvement, this is a continual exercise that has to become part of their standard business practices.
Absolutely. And what we want to do is identify those things that will be most impactful quickly, help them get started, get some wins, teach them how to make process improvements so that when we leave, they're able to, as you said, continuously do that, because that's something that never stops. The world is changing. Their markets will change. Their customers will change. Their supply chain changes over time. So how do you continually look for efficiency improvements? It just becomes a way of doing business. How do we efficiently run our business every day in the future? And people get scared about cost reduction because they think it means employee reduction. It doesn't mean that at all. It's just waste reduction, because we want to keep our employees and let them have more work, grow the company, them to make more money, them to be more engaged in the community along with the business. So everyone The business owner, the employees, and the community all win in this kind of transition, and that's what we want.
Well, these are all one side of or one variable to the equation when we talk about increasing EBITDA. Of course, the next thing we're going to talk about, Bob, when we come back is the multiple and things we can do to improve that multiple and improve the valuation of the company and the appeal to an outside investor or a third party on that side.
Yes, absolutely.
Okay, Bob, so we've talked about increasing the EBITDA. Now we're going to slide on over. We've got that same goal. We've got a $5 million valuation. We want to take it to a $10 million valuation. So how can we do that by increasing the multiple? So in this case, we've got a $1 million EBITDA. So in order to get it to a $10 million valuation, if the EBITDA does not change, we need to get that multiple up to a 10, where it's currently sitting at a 5.
Yes, and we're going to do this with holding the profit constant and not make another dollar of profit and do it all through the multiple.
Absolutely. So, I think when you talk about increasing the multiple, Bob, we're really talking about increasing the attractiveness of your business to an outside firm or to an investor.
That's exactly right. I sort of liken it to, you always want to be a playoff contender. You may not be going to the Super Bowl every year, but you want to be in that mix that's eligible to compete at that level. So what we tell companies is try to become the number one or number two provider in your geography. For instance, if you're an IT provider in North Carolina, you're not necessarily competing against IT companies in the state of Washington or California or Texas, but try to become the number one or number two in your niche in your part of North Carolina. Maybe it's Western North Carolina, but try to be that. So what does it take to be there? What does it take to get that? It takes differentiation and innovation in the market. What types of services are you delivering better than what your customers or what your competitors are delivering? What's going to make the customer want to be attracted to you? Is it that you have a 24-hour response time, or that your reputation is that you always solve their problem the first time, or that your staff is the most knowledgeable and courteous when people call in or when you meet in person, that they can always count on your company being the one that solves their problem or their issue? That's how you become number one or number two in your geography. And that's where investors, new owners, private equity firms, even lenders, that's who they want to be associated with. That's who they want to look at. They don't want to look at the number 10 company in the market. They want to look at the number one or number two. So what do you do different and better than your competition? Or what do you need to strive to do different or better than your competition?
I always explain this to people as liking it to a retail business. So, we've all got what I kind of think of as our favorite stores. So, not all Subway restaurants are created equal, Bob.
Right.
They all sell the same sandwiches, but in my particular case, I'll drive that 3 miles the other direction to go to the one where I consistently have a better experience. And that would be an example of a way that company, that franchisee, is increasing their multiple.
Absolutely. And not to pick on Subway, you can look at others, but because I travel as you do, a great part of the time, tend to get in habits, tend to go to the same kinds of places to eat. And there's a great variance in how many of these stores, whether it's Subway or Chick-fil-A is a great example, and others are run. How clean are they? How efficient are they? How friendly is the staff? If there is a problem, how quickly do they solve it? How do they treat everybody? It really makes a difference, and that's why you say, I'm willing to drive 3 miles further for that experience. And what that does is that helps you in the marketplace. When you're recognized that way, people are willing to pay more, which means more profit, because you have invested in those skill sets and that customer attitude. And liken it to a retail is very effective because even if you're not in the retail business, the people you're selling to, they are consumers of retail businesses. And that sort of becomes the standard now. If I get treated this way at a retailer, I expect my wholesaler or my supply chain or my customers, we want to have that same kind of relationship. So A customers are the ones who are willing to pay for that kind of better service, better experience, better differentiation, better innovation in the marketplace. Value and service they're willing to pay extra for. Makes your company more valuable. You have better customers. They pay more. They pay sooner. You have less problems. All those things help make your company more valuable.
Well, we've talked about A customers. Let's talk about A vendors. This is something that I think is often overlooked. So often we see clients that are simply shopping their vendors on price, especially if it's a commodity vendor. I was in the wireless business for several years, and there are hundreds and thousands of wholesale wireless dealers, and they're all selling car chargers and they're all selling cases, and often they're the same thing. But even when I'm getting the same quality, right? If I'm not going to try to save a nickel if I can't count on the product being delivered correctly, the order coming in as I ordered it. All those little intangible things outside of price that have a direct effect on the day-to-day operation of my business.
Yes, that's correct. For most businesses that we're dealing with, the quality of the product, is it engineered and meets all the customer's requirements or exceeds all of the customer's requirements? What kind of warranty? What kind of service comes with that product or service? What kind of support is there? People are willing to pay for that because when they have a problem, they want it solved quickly. And if they can depend upon you to solve that problem, that's the kind of vendors they want to deal with. And that's the kind of supply chain that we need when we're the company and we're lining up our vendors. We should be willing to pay more for vendors that want to partner with us to help us solve our customer issues. So having the right supply chain and having A vendors, just like you have A customers, very critical to long-term business success and increasing the multiple. When an investor looks at your business, if you have A customers and A vendors, that multiple starts to rise. And that's what we want. The value of that business is higher.
Well, speaking of things that you're willing to pay for, one thing that we've stressed with so many clients is that they should be willing to pay more to attract and retain A players as part of their team. Out of all of our AAA here, Bob, out of the customers, the vendors, I think it's fair to say that having that team of A players can be the biggest factor in increasing that multiple when you're looking to sell your business.
Absolutely, because people can come into a business as a new owner. They can sort of change some of the customers. They can try a new marketing strategy and get some new customers. They can change the vendors. It's harder to change the players because it's harder to find players better than you have today over the short run. Maybe you can over the long run, but it takes money and time and effort and energy to do that. So if you have A players intact already, yes, that absolutely makes your business worth more. If you think about it, your A players, that's who's dealing with your A customers and your A vendors. And that's why having the right players are so important. And if we have to pay $5,000 or $10,000 more a year than we want to attract an A player, all things being equal, I say go for it every time. It'll pay multiple dividends for you. I've seen so many companies have the wrong players in key positions, whether it's VP of marketing, CFO, COO, all your key positions, you better have A players because those A players will attract the next level of A players in the middle management ranks and then to the lower ranks as well. And pretty soon, 2 or 3 years from now, you have a company of almost all A and or B players, which is really strong.
Bob, be the company that competitors want to be. I love that line. It's right there with the greatest quotes, such as, be the person that your dog thinks you are, right?
Yes, yes, if only I could be. But yes, that's the goal, because you should be able to look around today at your competitors in your geography and say, who do I want to be like? Who's doing this right? Who do I aspire to be? And if there is somebody, then you need to aspire to be as good as they are. What you want to be able someday to look around and say, there's nobody I'm competing with that I want to be. They all want to be me now. I'm at that level. I'm at the A level across my companies. Not perfect. We're improving every day, but we're now what everybody else wants to be. We've become the example. I think that's what every business owner deep down really wants to be. They want to be who everybody else looks to as a leader in their industry.
And that can be a hard conversation, not just to have with others, but a conversation to have with yourself, to accept where you are in that hierarchy of your competitors right now, and your potential to increase that.
It's always hard to look inside for all of us and look in the mirror and say, okay, I'm not who I want to be. So what do I have to do today and every day to be who I want to be? And that's, as you said, that's a hard conversation. And we've had to have that with some business owners. But the ones who hear it and respond do very, very well. And we're all like that. I've had to do that many times in my business, is to look in the mirror and say, we're not cutting it the way I want us to cut it anymore. We got to do better.
Well, we've talked about increasing the EBITDA. We've talked about ways to increase the multiple now. Obviously, the best strategy is pieces from both sides of these variables to, in turn, increase that business valuation.
Absolutely. We need to both work both ends at the same time, because as we do better, these things become complementary, not contradictory. And they each build
Absolutely.
on each other. And that's what we really want. We get a lot of synergy that way.
Well, let's go ahead and take one more break here. And when we come back, we'll wrap this business valuation presentation up. And we're going to talk about exit strategies and what some of those options are to exit, and also how we go about planning towards that day.
Sounds great.
Okay, well, we are back with the final segment of our little business valuation series here. And, Bob, one thing we're going to talk about now is exit strategies, what some of those different strategies are, the different options that you can take, and also how we have seen those different options traditionally play out with our clients, what the end results are. So why don't you walk us through, we've got 4 or 5 of what are, I would consider, our standard laundry list of options when you talk about exit strategies.
Sure. Not surprising, many business owners want to somehow pass their business to a family member and or a set of key managers. They've worked 25, 35, 40 years in this business. Many people have been with them most of the time. And so they want to be able to pass that business to the people they want to have it, to carry on their legacy, their vision, their dream. Maybe some of that gets modified along the way a little bit, but they want to be able to retire and know this business is going the way I want it to go. That's more important to them than the highest dollar in return for the selling of the business. So we probably see that about half the time. That's the option people select. A lot of people who don't have that, either that's not important to them, or they have nobody that they want to succeed them in the business, but they want the business to continue and they want somewhat of their legacy preserved. They'll look to merge or be acquired by another respected industry player, some other person that's number 1 or number 2 in their geography, maybe outside their geography, but in their major industry. So we see that scenario quite often. We tend to be on the other side of these. Private equity firms will purchase independently a business. And sometimes private equity firms will bring us in to help integrate into their portfolio. So we work with sort of the former family owners in that transition period. And that's usually more of a top dollar, but there's no real continuation, no long-term continuation of the current owners. They usually work a transition period, sometimes a year or two, as an advisor or consultant. But normally a third party is going to put their own management team in. So that's not important to the current owner. They're looking for the top dollar. Unfortunately, sometimes we see businesses that don't do enough planning and they just have to liquidate their business at some point when they're able to retire. And it's not really continued, but it's a liquidation scenario. And the worst case for me is to see a business that just has to close because they've made no preparation. They have nothing of real value to sell, and they end up closing it. And that's a very sad scenario. We've seen it play out a couple of times. We don't like it, but that's sort of the gamut of what the possibilities are. So we try to focus on the top three with people.
Yeah, as you said, I'd say over 50% of our clients are looking for some type of succession planning.
Yes.
We work with a lot of family businesses, and sometimes it's a family business where maybe they don't want to pass it on to the family. Maybe there's no son or daughter that's interested in the business, but they're passing it on to employees that have become like family over the year.
Yes.
And that's either way, it's really the same planning that has to take place for something like that to occur.
Yes, and a lot of people, when you use the term succession planning, which is the right term, it's a broad term, but a lot of people think tax, and that's not what we focus on. A lot of people think legal, that's not what we focus on, but we try to help them in the operational succession planning. How does that company successfully go from one owner or some multiple owners to a new set of owners, family, non-family, key managers, whatever it is? How do we make that transition internally successful? And as you said, more than 50% of the time, that's what our clients want us to help them do.
And then of course, as you talked about, with a merger, often that's your chance to really maximize your value. Because you can attract, especially if you can attract the right party to merge with, and you've got a valuable asset that will help them grow or expand their business, but you're really giving up control at that point.
Yes, you are. Investment bankers will work what we call the sell side. They'll work for the owner and help them sell that business. A lot of private equity firms are the buyers. Sometimes private equity firms search out their own for new portfolio companies without an investment banker or advisor. Independent business brokers sometimes sell smaller businesses, probably most of them under 5 or 10 million in revenue. But yes, when you're selling to what I would call purely a financial buyer, then and they may have some industry synergies, but you're going to give up control, but you're going to have the maximum dollar return. And some owners, that's what they're interested in. And we try to help them do that if that's what they want. Not much succession planning because the new buyer normally has that in place. Sometimes they'll hire us to help make a short transition till they can get the management staff in place. But there's a percentage of owners who like to do that merger with an industry player because maybe their dream was always to become a bigger player. And even though they're going to exit, their company is now a bigger player in the market.
Yeah, so I think it's important to remind people that rarely, if at all, do we see a one-size-fits-all solution here.
Correct.
And each one of these different options that we talk about, they all have variables. They're all negotiable. We don't have any two clients that, even if they were both doing, succession planning where they're doing some type of employee purchase option and exiting that way, it never looks exactly the same. Things are similar, but there's always variables within each company as to the best way for things to go forward.
Absolutely. As you said, it's all a negotiation. There are many variables. And that's why, most people only sell or merge or have their business succeeded once in a lifetime. So it pays to have, professionals that have done it before to help you. Some people need a lot of help. Some people only need a little bit amount of help. But it pays to have somebody who's been through it before to help advise you and guide you through the process and do the things that you don't want to do or don't have the capability or the capacity or the desire to do. And there's nothing wrong with that.
Now, Bob, we touched on liquidation and just closing the business, and as you said, these are both very sad worst case scenarios. But perhaps even sadder is the fact that a lot of times this could have been prevented if just even a few years prior there'd been some type of exit strategy planning. But things change. People have personal events, they have health issues that, all of a sudden what they were able to do yesterday, they can't do today. And because there's no plan in place, the business just collapses.
Yes. And most people think that it's due to an external event. And sometimes there is an external event, but normally that event just pushes them over the edge. They've had years of not planning, and not cultivating A customers, A vendors, A player employees. They've not kept up with technology. Not that you have to be on the leading edge of technology, but you at least need to be where the market is. Not maybe reinvested in their equipment, in their business, not have the right processes. So they don't really have anything but maybe a Rolodex of some customers and some contacts, but there's not enough synergy there to have a core business that somebody else is willing to come in and buy because they can't operate at day one. They've got to fix it. It's more or less distressed at this point. Some people, there are some distressed buyer specialists who this is what they do, but in order to protect themselves, it's pennies on the dollar that they purchase it for because they've got to invest all their money basically in a fresh restart of the business.
Okay, Bob, well, let's wrap this up with our key takeaways from this. I think at this point, everybody can remember the formula. EBITDA times your multiple equals your business value. The absolute best strategy is not to put all your eggs in one basket, but to look for multiple areas to increase that EBITDA, to increase that multiple, and to have an exit strategy in place. When you do those things and you know what your contribution margin is, you've got those A players, you've got those A vendors, you've got those A customers, you're really setting yourself up for success.
Absolutely. And it's a process, and it takes some time depending on how far you are from it today. But I've never heard a company say, I'm sorry I did those things. It's always rewarding. Even if you don't get all the way finished with where your original goal was, you're that much closer, which means your company is that much more valuable.
Well, Bob, as we wrap up here, we've got our contact info up on the screen. People can find us on LinkedIn. They can find us on the website, of course, phone number, email. And I always encourage folks, please don't hesitate to reach out. If you've got a particular question about something that we've talked about in here or something specific to your business, hey, we always want to talk to potential clients first, and we're glad, even if we don't have the right answers, to point them in the directions of people that do. Is that not right, Bob?
Absolutely. If we're going to work with somebody, we want to partner with somebody where we're a good fit. And if we're not a good fit, that's fine. We're glad to say so and help them find somebody who is. Maybe outside our skill set, that's fine. We certainly can't do everything. We think we're good at the things we are good at. But we love to talk to people about their business, find out what their goals are, their dreams are, see if we can help. And if we can't, we'll partner with someone who can.
Sounds good. Thanks for meeting with me, Bob.
Thank you, Davey. Good to see you.